Good morning, everyone.
Good morning.
Good morning, sir.
Good morning.
Good morning, sir.
So we are starting up with a new session, which is leading up to the next March 2021 examination. Even though the two examinations that were due for March and September were not conducted, but hopefully, I think those will be conducted in a short while. But our objective is to meet the target of March 2021. So I welcome you all for the new online program this time, and I would appreciate if you all can mute yourself while the session is on so that everybody can hear clearly. And also I hope everybody is safe and in good health. So let's kick off the presentation, and I hope you all can see my screen, presentation screen.
Yes.
It's visible, right?
Yes, sir.
Right. Okay.
Yes, sir.
Yes, sir.
Fine. So,
Yes, sir.
as you all know, this program is structured for the IBSL candidates to enable them to have a basic knowledge about business accounting in order to address their day-to-day operations wherever they come across the financial accounting aspects, especially in the case of evaluation of financial statements with regard to your customers who may apply for loans or various other purposes. So the basic objective of this program is to make yourself aware of the basic accounting principles. So in that course, as you all know, the accounting field has undergone so much of changes, and mainly the accounting standards that are governing the business account, in other words, the accounting perspective, there are so much of accounting standards that get involved in the account preparation, financial statement preparation. So when it comes to our particular program, this particular program, we will be also covering certain accounting standards, but not all the standards in detail. Wherever that is relevant for us, that will be covered in during this program. So with that backdrop, let me go into the first topic that we are going to discuss today. That is about the business organizations and the business environment that we are operating in. So first of all, let us understand what are the business entities that we are encountered with. So there is a direct relationship between accounting and the business that we are in. What is it about? Because all the business transactions have to be accounted, or in other words, you have to make them recorded in your books. So as a result of this, there is a direct relationship between accounting and the businesses that are operating in. So accounting may not exist, in other words, if the businesses are not there. So accounting evolves along with the businesses. So if you see, there are so much of advancements that have come across in accounting purely based on the businesses. In order to cater the complications or maybe the requirements of various types of businesses, new accounting standards even have come. So it is very clear that the accounting and the business has a direct relationship between them. So what are the businesses or the business organizations that we are encountered with? Especially an entity means that is the business or the company which continues with profit-making motive. So as you all know, the business has an objective of making profits. That is, for sustainability of the business, you need to make profits. But there are organizations which are not for profit also. That is purely looking after the well-being of the community or maybe the society, where those companies operate without a motive for making profit. But every other business will have a motive where to make profit to sustain themselves. There could be entities which manufactures goods and services, and then they sell them or distribute them. So why this becomes very important is not every company will manufacture goods and services, or in other words, manufacture goods. Some companies, what they do, they purchase it from somewhere else and they keep a markup and they resell it. But when it comes to the service organizations, such as banks especially, what we do is we provide financial services to the customers. But this also is like a criteria for the business organizations. And also there could be entities or the businesses where it is an employment generation entity, creating employments to the public or the society. So you get so many kinds of business organizations which are operating. And finally, we also have, it is as a process that develops the wealth of the investors. So there are business organizations, or in other words, you might see there are wealth organizations. So which are targeted to develop the investors' wealth, looking after their well-being in terms of their investments is also a business organization, type of business organization. So what are we talking about as organization? An organization is a social arrangement which pursues collective goals, controls its performance, and has a boundary separating it from its environment. So, in other words, an organization is called as a social arrangement which looks after some collective goals. Now, in your respective organizations also, you have a vision statement. What does this vision statement says? Where this organization wants to be. Where this organization wants to be. That is, in other words, we call it as a goal. In order to attain that goal, you have a mission. How you take forward these activities. So when it comes to an organization, it is known as a social arrangement which pursues the collective goals. The collective goals may be for the organization per se, or maybe the individuals who are involved in the social arrangement. Some examples of organizations could be the multinational manufacturers. The multinational manufacturers means, for example, you may take Toyota, where they produce cars and it is going all over the world. So they become a multinational manufacturer who produces and sells goods to the entire globe. Or there could be local product manufacturers. Local product manufacturers. So their prime objective is to cater the products within the locality of the country. So they are known as the local product manufacturers. Or it could be a local authority. It could be a local authority where we might get our services fulfilled. And as I told you, there could be charities also. So a charity also is, in other words, known as an organization because they also operate with an objective or a goal. That is to serve the community. And finally, there could be a trade union also. A trade union is also known as an organization. Why? It's a social arrangement where they also have certain collective goals. So the objective of the trade union is to look after the well-being of the members. So these are, of course, just few examples, but you can classify them into various categories other than what is shown here. So let us now look at identification of organizations. In order to identify an organization, there are several criteria. So let's look at one by one, starting with the ownership. How does the ownership gives an identity to an organization? So we know that some of the organizations are owned by private owners, or we call them as shareholders. Let me come to the term shareholders, but some of you might already know. These companies are owned by private people, or in other words, a set of people. We are calling them as private owners, or it could be the public, where we call them as shareholders. And these are known as private sector organizations. Private sector organizations. But there are also public sector organizations serving to the community. And those are known as, or in other words, they are owned by the government itself. So we have two classifications here in terms of ownership, where we call them as private sector organizations or public sector organizations. What is the differentiation between the two? You can easily say that the public sector organizations are owned by the government. So in other words, all of the organizations that are owned by the private is known as a private sector organization. The second identification criteria could be in terms of control. In terms of control. How the organizations are controlled or managed. Some are controlled by the owners, but many organizations are by people working on their behalf. By people working on their behalf. So this needs a little bit of explanation. What do you mean by this? Now, if you take a small grocery shop, which is again an organization where several people might be working there, and this particular grocery is owned by one person. So there is a business running on. Now, who is going to control this small business concern or the grocery? It is the owner. It is controlled by the owner. Now, let us take another example where we look at a larger company. Now, these companies are then again owned by private owners or the so-called shareholders. Now, do you think these owners or shareholders are going to sit and control these companies? No. There will be nominated people who will be controlling or directing these organizations. Now, who are these people? Now, when it comes to the control perspective of organizations, we have a concept called principal and agent. The principal being the shareholders, and the agents being the people appointed by the principal. So when you take a large corporate, those are managed by a set of people called directors or board of directors. These board of directors are nominated or appointed by the consent, with the consent of the shareholders, who are known as the principal. So there is a relationship between the principal and the agent in terms of control. So the organizations are controlled by the agents who are known as the board of directors, and their objective is to provide an adequate return to their principal, who is the shareholder. So what is going to happen here? There is a set of people who are working on their behalf, means on behalf of the shareholders, looking after a return, a better return for their investment. So when we go on, we will discuss this in detail in coming subjects or coming chapters. So let us, for the time being, you know that certain companies are controlled by the owner himself, or the owner itself controls the company. And there are certain companies where the owners are there, but they appoint or nominate people on their behalf to control the company. And thirdly, we look at in terms of the activity that they perform, what kind of an activity that the company is performing. So these are broadly classified into, they could be into the manufacturing category, where, as I told you, they must be manufacturing goods. Or it could be a service, such as the healthcare. So we call them as healthcare organizations, where they are providing a service. The end product of their that company is going to be a service that they provide. So let us look at banks. What do? They provide financial services to the customers or to the public. Then it comes to the legal status. How does the legal status identifies a company? So we can put them into two broader categories. One is called the limited companies, or the other is called partnerships. So the definition for limited companies we will discuss in detail later, but let me give you an idea of the partnerships. Now, when one person starts a business, that person becomes the owner of the business. Now, after a certain period of time, he wants to bring in another person into the business. So let me call his friend coming into the business. Now, there are two people involved. Now, both of them are contributing money into the business. As soon as both of them contribute money into the business, which we call it as capital, the money that they put in is called as a capital. When they contribute capital to the business, it becomes a partnership. It becomes a partnership. So later on, we will learn how, what is a partnership and how that turns into a company. And another criteria could be the size or the scale of the business. So we know for sure that most of the businesses that we see today are started as family businesses. These individuals started their business within their family, where the father runs the business and the son then takes over, or maybe the son or the family get together and run the business. So these are called in terms of small family businesses. And later on, these small family businesses becomes larger companies, larger companies. What do you mean by that? They become multinational corporations, multinational corporations. So what do you mean by here? In terms of size, you can have small family businesses, or you can have high scale businesses which are known as multinational corporations. Multinational corporations. So these are the broad categories of businesses, types of businesses. So let us go through one by one. As I told you, when there is a single owner starting a business and running the business and controlling the business, means that type of a business is known as a sole proprietorship or a sole trader, where the organization is owned by one individual. It could be anyone, but this individual is the one who has started this business, or his idea is the one which has turned into a business, and he is the one who has put in capital, or in other words, money, brought in money or cash into the business to start this business. And when that person business is running, that is known as a sole proprietorship or a sole trader. Now, as I explained earlier, when another person gets into this business and contributes capital, it becomes a partnership. It becomes a partnership. Now, then again, this partnership is also basically profit oriented. You know why two partners are getting into is mostly, sorry, they're looking for business profits. So a profit oriented business which is run by 2 or more but less than 20. So we have to be mindful about what type of a business can be called as partnerships. Here we have 2 members getting into run the business, but they can have up to a maximum of 20%. The moment it becomes beyond that means you become a company. You become a company. And these companies are known as separate legal entities. Separate legal entities. Why? They are incorporated under the act which is known as the Companies Act number 7 of 2007. So the regulatory act which is governing the companies now, as of now, is known as the Companies Act number 7 of 2007, which is very important as far as your examination is concerned, because this will be learned throughout this course. So you may come across certain regulations that have come in. Those are enacted by way of this Companies Act number 7 of 2007. Then lastly, we have companies which are known as limited companies. So what do you mean by limited company? Is a company that issues shares and have the liability to contribute to the assets of the company under its article. So there could be candidates who are following this course where they might not know these terms sometimes. So I don't want to go into detail about this limited companies at this point in time, because we are introducing so much of terms into this business accounting module now. Say for example, there is a term coming in as liability, there is a term coming in as asset. So what do you mean by these? We will be learning later on. But just to give you a synopsis of what is limited companies is, where you know this company is already established by way of shareholders, and these shareholders have a liability. A liability means the commitment. This commitment is only to us to contribute to the assets, the level of assets of the company. So their liability is, their obligation is limited only up to the assets that are held in the company. Only up to the level of assets held in the company. Say for example, if the company's assets are, let's say, 10 million, and if the liability or the obligation that they have to meet is 12 million, they will meet the liability only up to 10 million. The 2 million, balance 2 million will be a loss to the people who have debted to this company. Now, the reverse of that limited company is where you have unlimited companies. So what is the difference here? Now you know that a company that issues shares and have an unlimited liability to contribute to the assets of the company. So it is very clear that certain companies, they are limit themselves up to the total value of their assets. But there are certain companies where they can limit their liability to that extent. So it becomes an unlimited company. You will also get state companies. You also get state companies. What do you mean by these? These are the companies registered under the companies, and more than 51% of the share capital is owned by the government. Now, I told you earlier, there are certain companies owned by the government. Now, the government can own it 100% or maybe a certain percentage. Now, here, these type of companies are where they own 51% or more. 51% or more. So when a company, when a government owns more than 51% of that company's shareholding, which means that becomes a state company. A state company. So you might ask why 51%? Okay. Now, if I'm to go and explain in detail why 51% is, that is, it will take some time. But let me give you a simple example. Let's say you have 10 apples. You want to divide it in between two people. So basically it is 5-5. Or in other words, 50% to both people. Now the moment you give more to one person, that person will have a better position to have more number of fruits. So which means, in other words, when you look at it from a business point of view, when you have more shares means you have more control. You have more control. So the moment you surpass 50% means there is a better control or more control. So with regard to the state companies where the government will own more than 50% means they are going to have the control over the company. And we also have state corporations. State corporation. These are known as companies owned by the government at 100%. 100%. So I have given some examples. Sri Lanka Rupawani Corporation, State Pharmaceuticals, and Water Board, and so on. So you know these companies. So there are state companies as well as state corporations. The next few slides, I'm not going to go in detail because these talk about the advantages and disadvantages of few companies in comparison. Say, for example, you take the sole proprietorship and the partnership, and you will see what these advantages and disadvantages are. Okay, so I leave it to all for you all to go through just for your understanding, but most of the things that we come across here may be useful when we learn the subsequent topics. Okay, so for the time being, just go through for your knowledge, but you will have a clear understanding of it when we learn all the concepts under this course module. And similarly, the companies. What are the advantages and disadvantages? So now we have a clear understanding about what type of companies are there and how they operate or in terms of size or scale, and how they are managed in terms of the control. But now what we are going to look at is who are the people who will be interested in a business. Now, why do you want to be interested in a business? Why do you want to be interested in a business? Because either you might be wanting to know the financial performance of that company, or maybe you are a regulatory authority, or you may be interested in the financial information for you to make an investment. So likewise, there will be several people or group of people who will be interested in a business concern. And mainly this is in terms of the financial information. Now let us look at who these users are of financial information. To start off with, as you know, I told you, the first category would be the owners, the shareholders, or the partners. So who are these people? The people who have put money for a business to run. And why it is necessary for these people to know the financial information of the company. That is the usefulness. Now here we say to decide on the investment, Now when you go and buy a product from a shop, you pay for it and you buy the product and you might consume it. If the product is not usable, you might sometimes go back and return it. So you have that option. But when it comes to these owners, shareholders, or partners, what they do, they put money into a business. They put money into a business. They can't go back and take their money unless they have a fair understanding about the business. So what does that mean is, for every owner or shareholder or partner to have a better understanding about the business, they need to have a fair knowledge about the financial information of the company. So when you get to know about the financial information of the company, you may tend to decide whether you want to retain the investment for the future, or should I take out my investment because I am not getting out of anything. If I'm not getting anything out of this business, then there is no point for me to have money being put into that business. So where we call it as to decide on the investment. Now we are talking about people starting up businesses, as well as we are talking about shareholders. So what do the shareholders do? They go and put money into the business and they buy shares. These shares will give them the ownership of their investment. This money will give them ownership for their investment. Now, the moment the company is not performing, they would want to take out their investment so that they can have a better return from some other business. Now, how do they know whether they are getting an adequate return or not? That is only identified when they go through the business performance information, which is known as the financial information. So we want to understand the financial performance of a company in order to decide whether I need to continue with the investment or not. Whether I need to continue with the investment or not. The second point that is there is to decide whether the organization can distribute the dividends. Now, what do you mean by dividends? Now, if I go and put or invest in a fixed deposit with a bank, what do I get? I get interest paid for that investment. So this investment will have a maturity, and at maturity, I will get the money that I have invested and the interest thereon. Now, the interest that I'm going to get is the return. The investment on that is the return is the interest that is paid to me. Now, when I go and put money in a company in the shares, there is no return as such. There is nothing called interest that is paid by the company for your investment. So then what is paid? Why am I putting money into the business? That is the big question. So the return that I get is when the company performs well, they earn higher profits, and in return to the shareholders, they give certain amount of the profit. Now you would have understood the concept where there are people called shareholders who are the principals. They appoint certain people known as the agents, and these agents runs the business. And when they make profit, this profit cannot be given 100% to the shareholders. Then if that is given 100%, then the sustainability of the business will be at a question. So what happens? Certain portion of the profit that they have earned is given back to the shareholders as a return for their investment. Now the portion that is given from the profits to the shareholders is known as, by the term, dividends. So I'm introducing several terms during this course for you all to understand, because those will be relevant for the future topics that we are going to discuss. So here we are learning an important term which is known as the dividends. What do you mean by dividends? Dividends is the return or the share of profit that is given back to the shareholders. Okay. So for an owner or a company that is managed by somebody, they want to know whether they can distribute the dividends to the shareholders. If you don't have adequate profits, how can you distribute the dividends to the shareholders? So you need to make a decision with regard to the distribution of the dividends, and that can be decided only when you know a clear understanding about the financial performance. So it is very important for the shareholders to know how much of dividend can be distributed back to the shareholders in terms of sustainability of the business. And thirdly, by looking at the financial information of a company, we may understand whether this company is stable or not. Sometimes we call them as financially stable company, where it could be a cash-rich company. So the stability of the company is also dependent on the financial performance. So the relevant financial information is required for the owners or the shareholders or the partners for them to understand whether this company is stable or not. Whether this company is stable or not. So that is the first category of users who will make use of the financial information produced by the company. The financial information produced by the company. Now let us look at the second type of user. We call them as lenders. Lenders. You might have heard these names. Sometimes you might call them as money lenders. So money lenders is actually a different type of business. But what we are looking at is, in broader perspective, who are the lenders? Now, why do you need these lenders? Because there are companies who will require capital or money in order to run their business. So the option available to a company to get money or capital is either they have to go back to their shareholders and ask for money or ask for capital. The second option available to them is where they can go to a financial institution to borrow money from them or capital from them. Now, who are the financial institutions available to us in that category? We have the banks, we have the finance companies, we have the leasing companies, and so on. So these banks, finance companies, and leasing companies are becoming the lenders to other companies. Lenders to other companies. As part of the financial services that they provide, the banks, they lend money to the needy ones or the people who borrow money, who require to borrow money. The banks will lend money to them. Now the banks, finance companies, and leasing companies are also interested in the financial information of a company. Now let's say ABC company is a company which is running and it is funded by shareholders. And now in order to meet their day-to-day operations, we call them as the capital required to meet the day-to-day operation is called as the working capital. You might have heard this term, working capital. So in order to meet their working capital, this ABC company might go and approach a bank. So now it is like a customer who is coming to your bank now. ABC company is coming to your bank asking for some financial support. Now, what is this financial support? That is what you call as a loan. So this lender now has to decide whether I can give this loan to this particular company, ABC company. And what should I look at? The first and foremost thing that I will look at is whether the money that I am going to give to ABC company is going to be paid back or not. If I give 10 million to ABC company today, are they going to pay me back the 10 million after a certain period of time, say 12 months or 3 months or maybe say 2 years or 5 years? So we are talking about a longer term. And am I going to give this loan freely? No. Being a bank, I am running a financial services organization, so I cannot be running this for free. I need to make profit. So what do? I will charge an interest from the company or the ABC company. Now what happens? I am going to give money to a company and that company has to pay me back the money that I have given and also the interest thereon as decided by the bank. Now from the bank's perspective, what do I look for? Whether this ABC company is capable of paying me back the capital that I have given or the money that I have given and the interest thereon which I have already decided. So that is what the first point is, to ensure the ability of recovering the capital and interest. Now, how do I decide? I need to go and look at the financial statements of ABC company, because I have to look at the history performance of them, how they have performed over the past years. Whether they have paid or repaid the loans that they have taken, or have they failed to repay the loans or the interest in the past. So as you know, you might not give a loan to a customer whom do you think that he will not pay. So likewise, even larger organizations such as banks, finance companies, and leasing companies also will evaluate the customer before lending. Now, why we are learning this course is to support you all with that understanding, to provide you with that understanding, to understand how you will analyze the financial statements of your customer. Why? To ensure the ability of recovering the capital and the interest. Secondly, we also want to understand what are the securities of the loans given. If the customer fails to repay the loan, how do I recover? The term security here means the collateral that the customer has offered me. Collateral means the safety cushion that I am going to have. So if the customer is not going to pay me the capital and interest, how do I recover it from him? That is the security of the loans given. So all these information is available in financial information that are provided by a company. Either they publish or they have their own annual reports. These information are available. And using those information only, a lender will decide whether I can make the decision for the lending or not. So the second type of user will be the lender. The third type of user, it could be the general public. It could be the general public. So this general public will be the community, or it could be the political parties, local communities, consumer groups. There are so many categories. Why they are interested in the financial information of the company? Because they want to understand whether the company products are good for the public, whether the company operations are badly affecting the environment. Say you might have a business which is making good profits. So when you look at the financial information, it is very clear that the company is making good profits. But what are they producing? They are producing some harmful products into the environment, which is damaging the environment, causing pollution in the environment. Then people will not be encouraged with that type of a business. Even though the company makes higher profits, the people or the public may not be interested in this business because they are causing a huge damage to the environment. So the general public is also interested in the financial information. The fourth category will be, we call it as the management. As I explained you, the directors, they come at the top. So as you know, the directors are the agents of the principal. And what is their responsibility? To make this company perform well and provide an adequate return to its principal, who is the shareholder. Okay, you see how these are connected, interconnected. So now, in order for the directors to know whether this company has performed well, what do they need to know? They need to have the financial information of the company. So they will understand whether the status of the company is good when compared to with the competitors. Now today in the business world, you know, there is huge competition. So one of the fundamentals that the companies do is they go and compare their performance with the competitors. So directors, or maybe the CEOs, or maybe the divisional heads, or maybe the managers, all of the people who are controlling these organizations, may want to know financial information about their company as well as how this can be compared with the competitors because of the huge competition that is there in the market. Secondly, they also would like to know whether the profit that the company is earning is adequate. Sometimes you might be making a profit, but that profit is not even enough to do a small kind of an expansion. So then the company has to decide, yes, we are making a profit, but are we making adequate profit where this company can run for another 10 or 15 years? So there is a linking where we will learn subsequently for a concept which is known as going concern. What do you mean by that? We want to know whether this company is sustainable, whether it is going to run for the next 10, 20 years. So as part of the management, they would like to know the performance of the company in order to decide how they can respond to their principal and how they can respond to the community. And the next category that we are going to look at is employees. Very simple. Why these employees may be interested in the financial information of the company? One simple reason. Just to know whether this company is capable of paying my salary in the next month. Okay. Simple as that. So you might have come across or you might have heard during this pandemic time period, a lot of companies went into a pay cut. Why? Because the profits were not sustainable. Because if they have paid high salaries, then the profits of the company might have eaten. So they had to bring down the salaries of employees and ensure that the company is running for the next few years. So in terms of employees, which also includes the office employees, factory employees, or maybe even the trade union. As you know, the trade union, the objective of the trade union is to look after the well-being of its members. So when the trade union goes for negotiations with the management for the members for salary increases or other perks of their members, they also need to know how the company is performing. Whether the company is performing well for us to go and ask for an increase. So it is very important for the category of employees to know how the company is performing. Why? To understand how much of a salary will be bearable to the company. Whether I can ask for an increase, whether I will get my bonuses. Big question. More importantly, I also would like to know whether the company will survive for a longer period. Why? Sorry. Because it could be a challenge for you to continue in the employment. It might be a challenge for you to continue in the employment because there can be a lot of retrenchments. People have been sent home. So it is very important for the employees also to know the financial information of the company for them to make certain decisions. And the next category is known as the suppliers and creditors. People who supply goods to the company, such as raw materials, subcontractors, service providers. They are also interested in this company. They need to know the financial information of the company. Why? Whether the company is a major customer at the moment. If they are the major customer and if that company is not performing, then you're also not going to have your revenue generated. Secondly, if you are a company who is providing services to another company, you would like to know whether you will get paid for the service that you provide. So whether the company is in a position to settle the debts. The debts means something. If you have obtained a service or a good, you have to pay back. So whether the company is in a position to settle those debts. So people like suppliers and creditors also would like to know whether the company is in a position to settle the debt. So based on that decision only, I will go and provide you a good or service at the next time. Otherwise, I will immediately stop my goods or services being provided to the company. And the next category, most important one, the government and other regulators. So every businesses that are running on the earth being governed and monitored. How? There are tax authorities to see whether the taxes are being paid properly. There is stock exchange, whether the regularities are met by the companies. Central bank, especially to monitor the operations of the banks. And there is also consumer authority to ensure that good products are being produced by companies for the consumption of the public. So these government and other regulators are operating, and they are also interested in these financial information. Why? To see whether the company has paid taxes. Because the biggest source of revenue for the government is the taxes paid by the companies. So it is important for the tax authorities to know what is the financial performance of the company. Secondly, whether the company has adhered to the regulations. If the stock exchange is publishing a regulation today, that has to be complied by the companies listed on the stock exchange. So it is very important the regulators to know whether the financial performance of the company is in order. Thirdly, whether the disclosure requirements in financial statements have been made. Now, I don't want to complicate you all with the term disclosure requirements. We will learn that in detail. But as you all know, for an example, every bank is required to publish their financial statements in the newspapers. Why that is happening? Just to make the public aware of the financial performance of the bank. So that is a disclosure requirement. And what do the central bank do? They go and monitor and govern these banks and ensure that the financial statement disclosure is provided to the public for them to know. And the last point there is whether the activities of the company is detrimental to the customers. So if you are producing a product which is harmful to the community, then that has to be banned. That product has to be banned, and that company should not be allowed to continue. So there can't be a company which is producing detrimental products. So all these are required when you look at the financial information. So now we have gone through several users of financial information. Owners, shareholders, lenders, and then the general public, management, employees, suppliers and creditors, and lastly, the government and other regulators. So in other words, we know all these parties or the users are interested in the affairs of the company. So as a result, we call all of them with a special name, because that name is widely used now, so you need to know. There is a special name given for all these people or parties who are using or looking at a company's performance. They are known as Stakeholders. Stakeholders. Already we have learned a term called shareholders. Now we are introducing a new term which is known as stakeholders. Stakeholders. So it is very important to know who are the stakeholders of a company. Who are the stakeholders of a company? So I have listed here about 6 categories or 7 categories. So which means all these are falling into the category of stakeholders. So with that, we will get on to the accounting environment. The accounting environment is of 2 types. We call them as internal environment and the external environment. Where the internal environment is controlled by the management. People who are managing the business are going to control this internal environment. But external environment is beyond the control of the individual business. And the business may not have or may have to adjust itself to the changes that are happening in the external environment. Okay. So who is the internal environment? You know, the shareholders, managers, employees, and most importantly, the entity's nature and culture. So all these elements of the internal environment are going to have an impact on the operations of the company. But let us look at the external environment. What you see here is known as all the external factors that are going to have an impact on the organization. What are those? The legal aspect. Any legal changes that are happening on the external environment, sometimes they might have a direct impact to the organization. There could be economical and political changes. Those will have an impact on the environment. There could be social and cultural changes, which may not be matching with the culture or the culture that is being adopted by the company. So you might have to change the company operations to suit the requirement of the social and cultural. And there could be technical and professional advancements that are happening in the external environment. You have to abide by those. And most importantly, there will be technological changes. The company has to be geared for those changes. Now, today you might see a lot of companies are looking at going into digital platforms to take their businesses into the digital platforms. As I might say, this pandemic that we are going through has brought in a lot of businesses into the digital platforms. You might see there are a lot of businesses who are now operating online. From the traditional way of doing businesses in a business store or an office space, they have moved into the online platforms to run their businesses. So that is the external environment. Something which is happening in the external environment has forced the business to change its business model. So the factors that I have put in here all will have an impact on the businesses. So the business has to gear itself to cater or to mitigate all the impacts of all these external factors. And finally, I'm just giving this as information. So we will look at it later on when we come to understand what these functions of these committees are. Because as you know, most of the companies are managed by the internal environment, or the management, or the directors, CEO, and so on. So in order to run the operations, these management will form several committees. These are known as executive committees, standing committees, ad hoc committees, subcommittees. There are so many committees which will look after certain functions of the company or certain aspects of the companies. So that is what I have listed in this particular slide. Okay. So that is all about the business environment and the business organizations that we have gone through under the chapter 1. So I would like to ask from you all whether you have any questions that you want to raise. Am I audible to you all? You all hear properly?
Hello, sir. I'm unable to see your screen slides.
Yeah, hold on. I'm yet to share that screen.
Okay.
Is it visible now?
For me, I'm unable to see.
Can we have a feedback from others, please?
Can see, sir.
You can see, right?
Can see, sir. Can see.
Okay. Right. So we are getting into the next topic, which is about the framework for financial reporting and preparation of financial statements. So before we get into the nitty-gritties of this business accounting module, there are certain basics that we need to know. So that is what I'm going to do now. Maybe the first 2-3 lessons we will understand the concepts and the framework and the process of preparing financial statement, and then only we will get into the details pertaining to the subject. Okay. So let us now look at the framework for financial reporting and preparation of financial statements. So the first question that we need to answer is why you need a common framework. Why you need a common framework. So one of the objectives of accounting is to communicate the information about the organization to the stakeholders. So as I told you, now I have already introduced the term stakeholders to you. So by this time, you know who is a stakeholder is. So now we say that one of the objectives of accounting is to communicate the information about the organization. Yes, that is what we have looked at. Users of financial information. But from the perspective of the company, it is their responsibility to communicate the financial information to its stakeholders. Now, that is an objective. Every company has to do it. And the accounting is considered as the medium or the method that is used to make this communication. So by way of having accounting only, I'm going to communicate with the stakeholder about my financial information. So that when I communicate the financial information to the stakeholders, they make economic decisions. Now, if any one of you are having handouts, which is very important, please underline the term economic decisions. So the users or the stakeholders now going to make economic decisions based on.
So we don't have the tutor of the second chapter.
Oh, I see. But you all can see the screen, right?
Yes, sir.
Okay. Okay. So you can follow. Meantime, you can follow the slides that are projected, and later on you can take down your notes. So the financial information that are provided by the company is used by the stakeholder to make economic decisions. So some of the decisions that they make only what I explained in the previous chapter. Say for example, if the tax authority is not getting information, then they will not be in a position to understand or identify how much of tax this company has to pay and how much they have paid. Because in order for them to understand and calculate the amount of tax to be paid, they need to have the financial information. So that is the economic decision that the tax authority has to make. Secondly, let us take a stakeholder who is an investor. Now, if you don't publish your financial information, then the investor will not know whether the company has performed well. And if the company's performance is not known to them, they are not in a position to identify or understand whether they are getting an adequate return for their investment. So it is very important for the stakeholder to know the financial information for them to make an economic decision. Economic decision is a fruitful decision for taking forward their investment or maybe their decision about the company. Any decision that they are going to make about the company is based on the financial information that is available. So it is therefore important maintaining quality, reliability, and uniformity in financial statements. The financial information that you are going to provide should have quality information. And it also should be reliable. If you are producing some bogus information to the public as financial information, then there is no point, because the economic decisions made based on those will not be fruitful. And also, you need to ensure that there is uniformity maintained. Last year you may publish something, and this time you are coming and saying something totally different to what you have said in the previous year. You can't have contradictory assumptions, or maybe without having any uniformity. Now let us look at the conceptual framework. The conceptual framework is a group of concepts. As I told you, we will be learning the concepts that helps to prepare and present the financial statement. Now, by this time, you know that the companies are preparing their own financial statements, maybe the banks, or maybe the trading companies, or maybe the established conglomerates. All those people are using preparing financial statements using their computer systems. Now, these computer systems are already configured to understand and work based on the concepts. And the people who are working as accountants or financial analysts or whoever you may call them are also aware of and knowledgeable about these concepts. So the financial statements that are prepared are based on a conceptual framework which is built up based on certain concepts, assumptions, and principles, you can call them. It also helps to evaluate the accounting process. So what do you mean by accounting process? The accounting process is how you start recording your transactions and up to the point how you publish your financial information. So there are a lot of activities that involve between the point in you identify a transaction and producing the financial information. That is known as the accounting process. So the main objective of this framework is where it explains the current accounting procedure that the company is adopting and justifying the reasons for selecting same. Okay, so we will learn as we go on, we will learn what is this accounting procedure and so on. So you will have to spell out the procedure that you have adopted to prepare your financial statements. And you have to also provide justifications for selecting same. And how your future accounting procedures should be. You need to also say about how your future accounting procedures should be. And most importantly, it also need to explain the important terms in accounting standards and their limitations. So what you see here is known as the main objective of the framework. But in a nutshell, I can tell you that what are we trying to explain here? The financial statements that you prepare are based on a certain accounting procedure. And this accounting procedure is built over by using the concepts, principles, assumptions, and which are governed by the accounting standards that they are built upon. So financial statements are, in other words, prepared in compliance with the accounting standards. So you cannot be doing something which is beyond what is meant or spelled out in an accounting standard. Then it becomes something controversial with regard to your financial information. Fundamental accounting assumptions. So the framework that we are going to use to prepare the financial statements gives us certain assumptions. One of the first and most important assumption that we make is known as the accrual basis. So this is the starting point. We are getting into some important topics. The accrual basis will be there till the very end of this course. You will come across this term being used wherever possible throughout this entire course. So this concept, this is actually called a concept. This concept has to be understood very clearly. Accrual basis. So what does it mean? The effects of transactions and other events are recognized when they occur, rather than when cash or its equivalent is received or paid. Now, what does the accrual basis says? Now, you know, for you to report financial information, there has to be transactions. When there are business transactions only, you will have something to be reported. So if not, you will not have anything to be reported. So there is a relationship between the transactions and the information that you report. What you report is the effect of these transactions. So what is the effect? Effect is, we look at it from monetary terms. Every business transaction that will have an impact on your financial performance will have a monetary value assigned. What do you mean by monetary value? The cash value. So the business transactions are going to have a monetary value, And this monetary value has to be determined not by when they are received or paid. This is very important. Why you call it as accrual basis is that you cannot be waiting for a transaction to be recorded when you receive cash or when you pay cash. Okay? Because the underlying transaction or the event would have already occurred. Let me give you an example which makes you understand better. This is the example that I have been using throughout, but this is one of the examples that can be easily understood. Now let us take your home itself. So the December month has already started. Now you have started consuming electricity for this month. Now when you look at the consumption of electricity for the month of December, if you look at it, when will you get to know about it? The amount that you paid, you need to pay for the electricity board for the consumption of December will be known to you only in January. Am I correct? The consumption of electricity for the month of December will be known to you in January. Or let us take your mobile phone that you are using. You need to settle the bill, otherwise it will be disconnected. So your usage for the month of December will be known to you only in January. Where you will get an SMS, or you might get an email, or you might get a bill sent to your home saying that this is the amount you need to pay for the usage of December. Now what does this mean? I have used or consumed a service for which I will pay later. I will pay later. So I have consumed electricity, or maybe say the mobile services this month, but I will pay for it later, next month, or maybe beyond that. Same of that applies to the businesses as well. These businesses consume so much of services. They are entering into so much of transactions. And these transactions will result in a monetary value, or maybe you will receive or pay money later. But that has to be recorded as and when that happens. As and when that happens. So what do you mean by accrual basis is, you have to account for the transactions and events as and when they occur, rather than not when you receive cash or you pay cash. Okay? Most of you might be employed in the banks itself by this time. So you might know your bank will be using a lot of electricity. So the electricity bill will be received by your branch or maybe the head office, not in the current month, maybe in the next month. But when you are preparing financial statement, you have to ascertain certain value into your financial statements. And this could be based on your prior experience. Because until the bill is received, you don't know how much you need to pay. But based on your experience and the past usage, you have to account for it in the current one. Now this concept is known as the accrual concept or the accrual basis. What do you mean by this? The effects of transaction and other events are recognized when they occur, rather than when you receive or pay cash. When you receive or pay cash. By doing that, what is going to happen? You are going to report them in the financial statements also in the relevant period for which they relate. Because you know, financial information is produced for a certain period. Either it could be for a month, or it could be for a quarter, or it could be for an entire year. It is very rare that we prepare financial statements for a number of days. I'm giving you a financial statement for 10 days. No, we don't do that. Financial statements, that concept also we will learn later on. Financial statements are prepared for a particular period. So when you are preparing financial statements for a particular period, that period should cover all what is relevant to that period, irrespective of whether you have received cash or paid cash during that period. You might pay or receive subsequently. That is irrelevant. But the duty of an accountant or the person who is preparing financial statements have to ensure that all transactions that have happened during the particular period have to be accounted in that period itself. That is known as accrual basis. This is a concept that I have already told you. Going concern. What do you mean by going concern? The financial statements presume, that is, the financial statement that you prepare are already assumed on the basis that the entity will continue in operation indefinitely. So every time the accountant or the system, when it produces financial statements, the assumption that we take is that, yes, we are looking at the past, but we assume that this business is going to continue indefinitely. We don't know when it is going to end. We don't know that date. But we assume that this business is going to continue forever. Then only there is a meaning for your financial statements. The stakeholder who is looking at your financial statements also will understand that your statements are prepared on going concern basis. Sometimes what happens, certain operations you might stop, or you might come to know that you are going to stop it. So if that is the case, then you have to specifically mention in your financial statements that we have prepared these financial statements, but not on going concern, because we are closing down our business operations end of this particular period. So in general, we are taking a general point of view, that is, in general, when you prepare financial statements, you prepare them based on going concern. What are the qualitative characteristics that you observe in financial statements? So the framework that we are going to use identifies following qualitative characteristics. Qualitative characteristics. As I told you, the financial statements that you prepare are not going to have numbers. Mostly it is numbers, right? But when you produce numbers, those are known as quantitative. Those are quantitative characteristics. But there is another aspect to your financial statements. That is known as qualitative characteristics. That is non-numerical characteristics. What are those? Your financial statement should be understandable. When somebody is looking at your financial statement that you have produced, those people should be in a position to readily understand your financial statement. So who is going to understand? That is where you need to target. the information that should be presented in a way that is readily understandable by users. So who are the users? All those stakeholders will come. But those users who will have a reasonable knowledge of business and economic activities and accounting. So when you look at the large stakeholders, there is everybody. But your financial statements need not be understandable by everyone. Your financial statements have to be understandable by the users who have a reasonable knowledge of business. So people should know what is happening with the business. And they should know what are the economic activities that are taking place. And most importantly, what is accounting? Because if you are not a person who knows about accounting, then the financial statements cannot be interpreted. And especially on today's context, it is becoming more and more complex with the increased volume or the requirements of the accounting standards and regulations. It is very difficult for a layman to understand these financial statements. So the understanding has to happen by the users who have a reasonable knowledge of business and economic activities and also accounting. So the first qualitative criteria or the characteristic that your financial statement should have is the understandability. Secondly, we call it as the relevance. The information in financial statement is relevant when it influences the economic decisions of users. So we learn what is economic decision is. Now you have produced a set of financial statements, and if that financial statement is not useful for me to make an economic decision, then it is not relevant. We learned the category called lenders. So who are lenders? The bank. So let us assume a customer is coming to the bank, coming to your bank to obtain a loan. And when they come to obtain the loan, you will ask for the financial statements or the financial information. So you go through the financial statements. By going through the financial statements, you understand that you are not in a position to make the decision whether I can lend to this person or not. If that is the case, then those financial statements are not relevant. Because those are not relevant in terms of for the information that you are looking for. For you to make the decision of lending the money or whether to lend the money or not, you are not getting sufficient information from the statements produced. So relevance can help the economic decision makers to evaluate the past, the present, or the future events relating to the entity. So the financial statements that are produced always looks at the past. Okay, later on we will understand that the financial statement that you produce always looks at the past. You will talk about the year that is ended, or you will talk about the month that is ended, or the quarter that is ended. So which means financial information always looks at history. But it can also have an impact to predict the present or maybe the future also. So that is where a financial statement becomes more relevant for the user. Becomes more relevant for the user. Thirdly, and very importantly, whether the financial statements that I am looking at is reliable. That is very important. Information that is produced in the financial statement must be reliable or can be considered as reliable when it is free from material errors. The financial statements that you are preparing should not have any material errors. Material means, we will learn what is material also. The material means that can have an impact. You are trying to make a decision, and this financial statement, if you make a decision based on this financial statement, this will have a material impact. Why? Because it is not becoming reliable for you to make a decision. Reliability is affected by the use of estimates and by uncertainties associated with the numbers in the financial statements. Now, as we go on, we will learn that you will make a lot of assumptions, and you will also make use of certain estimates in order to prepare your financial statements. By any chance, if you make use of any assumptions or any estimate that is not realistic, then it is going to result that your financial statements may not be reliable. Your financial statements may not be reliable. So the reliability factor for a financial statement is very important. Another characteristic, qualitative characteristic, is where we call it as comparability. We call it as comparability. Users must be able to compare the financial statements of an entity through time in order to identify the trends in its financial position and performance. So, what do you mean by comparability? So, I would like to make use of the board. I hope everybody can see the board. Now, how many of you have seen financial statements that are being published? So if you look at the financial statements for a company, let's say your bank, I may call it as ABC Bank, without naming any bank's name. So let's take the balance sheet. We will not use the term balance sheet, but just for making you understand, let's say balance sheet. Now you will have your line items in the financial statements, and you will also have the numbers. So we are looking at financial performance of this bank for the recently concluded financial year, which is 2019. So I look at the numbers and I assume that based on the numbers that I have got, this company has performed well. This company has performed well. I make a decision, or I assume that the company has performed well. But that is not the correct way for me to make that conclusion. The most suitable option would be, I need to go and look at how this company has done in 2018. Now what happens? I have a benchmark for me to look at. Let me make this as the P&L, then it will be more understandable. So let's say this is the P&L of the bank. So we are looking at now 2018 also. The year of 2018 as well as year of 2019. Now in the year of 2018, let's say the company has made a profit of 5 billion. Billion. In 2019, the company has made 9.5 billion. 9.5 billion. Now, as I explained earlier, if I don't have this piece of information that is reflected here, what can you say about this? Yes, 2019, the company has made a 9.5 billion profit. That's it. But you can't make anything further out of this information. Of course, you have already understood. It is reliable. All those are there. But I can't make any further decision. The moment I bring in the 2018, what happens now? I have the option of comparison. We call it as comparison. Now what happens? Yes, I have earned 9.5 billion in 2019, but it was only 5 billion in 2018. So which means now the company has made more than 4.5 billion this year. Now you see, you can talk about a lot of things, which means the company has almost doubled its profit this year. How? By way of a comparison. You see, initially I had only this, where I couldn't say much about the financial information. But the moment I bring in this, I can compare. Like parents comparing their children with some other, or maybe say class teachers or whoever maybe. Likewise, the performance is also compared with what you have done last year. So now this gives you a lot of information. Why this company was able to make an additional 4.5 billion this year. Now you will go into details. What happened to this? What happened to this? What happened to this? You will compare each and every line. Okay? So now you will understand what is the purpose of comparability. You see, whether this company has done better than last year. How do you do it? The moment you give the comparatives or the comparison numbers, you can do that analysis. And from that, you get into so many other things. Whether this line item, why there is an increase, why the income has grown, whether they have produced new products, or whether they have expanded their business to promote the product in so many localities. So much of questions can be asked. Now I bring another question here. I bring in another bank called PQR. Now what happens? I'm going to ask the question whether ABC Bank is better or PQR Bank is better. That is the competition. So now, if I am to do the ABC Bank, PQR Bank comparison, I need to have the financial information. Both ABC Bank as well as PQR Bank. This is where the financial information becomes more and more important. Because for you to compare information, it has to be comparable. You can't compare apples with oranges. It doesn't make sense. isn't it? So likewise, your financial statement should be comparable with the financial statement of PQR. So the accountants or the computer systems, whatever that is producing financial statements, will ensure that it is comparable. So it is comparable not even within the entity or within the company. You compare this year with the last year. It should also be comparable with this company, with that company. So the term comparability is very, very important in terms of preparing financial statements. I hope that would have given a clear understanding of what comparability is. Okay? So what do you mean by comparability? Where users must be able to compare the financial statements of an entity through time in order to identify the trends in its financial positions and performance, and therefore entities must at least provide previous year's financial statement for comparison. So that is what I have already shown you on screen. The 2018 numbers are also provided along with the 2019 so that you make a better comparison of your financial information. So there are 4 characteristics, as I told you: understandability, relevance, reliability, and comparability. These are very, very important 4 terms. And in exams, sometimes you might have to write about four of these concepts, or maybe say characteristics. What does these mean? When you say reliability, what is that? Comparability means what? So you should be able to write about all those 4 qualitative characteristics. Now we come to an important section which is known as the elements of the financial statements. Elements of the financial statements. So in order to understand the elements of financial statements, let me again go to the screen so that it will be easy for me to explain. So let's talk about an example where I start a new business. So what do I do to start the business? I bring in cash. Let's say I brought in 10 million cash. Okay, 10 million cash. Now this 10 million cash is not mine. Okay, it's not mine. Who is the owner of this 10 million? I am the owner of the business, but this 10 million doesn't belong to me. It belongs to the business. Okay. Later on, we will learn that concept, which is called the business entity concept. So from the business perspective, you have received a cash item and the business has to be a balanced one. So we create this 10 million that you have brought in is an asset to you, or in other words, an asset to the business. Because you know, cash is a property that I own. So cash is an asset. But for the business point of view, the money that I brought in, I explained it earlier. What is it? Is the capital. So for the business, it is the capital. So I brought in 10 million cash. So I have an asset as well as I have a capital. Okay. Now this business is started and it's running. You have completed the first month of your operations. So what has happened? And let's say you are a company selling phones. Okay. So you have sold phones so that you have received money. From the sales, you have received money. Now what is the sales is? An income. Okay. Then during the month, you would have consumed electricity, you would have consumed water. So all those you have to pay in the following month, as I explained. So these are coming as payables. Payables, where I have to pay subsequently. And that payable is called as liabilities. Liabilities. Now you see, the business started with one transaction, which was bringing in 10 million cash. And that one transaction resulted in two elements known as asset, the other one is capital. And I am always looking at from the point of view of the business. I have a 10 million asset, 10 million capital. Now with that capital, I am running my business for 1 month. So I am selling phones. When I sell phones, I get money. That money is known as my income or sales or revenue. During that time, in the particular month, I have consumed a lot of electricity to run my business. So I am creating a liability, which is known as I have to pay for it in the next month or maybe in the future. That is known as payable liability. So now you will see little by little the type of transactions that are happening in a business or the types of elements that are operating in a business increasing. Asset, liability, income, and when you later on you will understand this is an expense. So as we go on, more and more transactions happen, the impact of those will go into each of these. Okay. So since the time is up, we'll have to stop there. We will continue from where we have left. And I hope the tute will be uploaded to the portal shortly. And we will meet up next week. Hope you all have understood what we have learned. So if you have any questions, you may always put it to me as a message in the portal or the text message here so that I will understand and respond to your questions. So we'll meet up next week. Hope you all do a revision before we come to next week.